All right, good Thursday afternoon, Finom Group members and our general YouTube audience. My name is Seth Golden, and we are Finom Group. Welcome to this week's State of the Market. It is September. We're halfway through the month. It is the third Friday of September. It is monthly quad witching options expiration week. We came into this week understanding that this could be a pretty turbulent week. It is jam-packed with relevant and highly reactive economic data, as most market participants witnessed on Tuesday with the release of the CPI. So let's get right into the meat of things, folks. Again, it is Thursday, so let's see what the market is doing. We are down across the board, not so much on the Dow, about a little more than 0.5% there on the S&P and about 1% there on the NASDAQ, as yields are rising, and we're looking forward to, I say that tongue-in-cheek, a rate hike at the upcoming FOMC meeting. So turbulent week so far. Friday, we have monthly options expiration. I wouldn't anticipate anything less than more turbulence. Nonetheless, bear markets are about buying value. That's the bottom line, folks. We're in a bear market. You're getting value. Bull markets are about realizing the profits from that value-seeking opportunity during the bear market. In other words, investors make all their money in bear markets. They just don't know it at the time. Here's a really good fun fact, if you will, regarding the S&P 500. When the S&P 500 is below both the 50 and 200-day moving average, as it is again here this week, more importantly, when the 50-day moving average is below the 200-day moving average, the S&P 500 has only its gains when it's the opposite. When the 50-day moving average is above the 200-day moving average. Historically, those are the only gains. Otherwise, the market's not making new highs. So if you're looking for a new bull market and the opportunity for the market to make new all-time highs in the not too distant future, you're going to want to see the 50-day moving average jump above that 200-day moving average. And that's why they call it the Golden Cross. Not named after me. All right. Now, the practicality behind that fun fact is, think about 2008 compared to today, right? At both 2008's bear market, the current bear market, the 50-day moving average is below the 200-day moving average. What are you getting? Value. We're getting value today, and that's the most practical understanding of that particular stat. All right, so it is September. We can see here, September, we're going to be going into the third week of September. That's what I have circled here. There's a lot of red on the screen, usually in that third and fourth week of September, which is typically the worst week of the year, next week. So things aren't great this week. So far, we're going to show a decline across all major averages. Next week may not be that good either. And remember, since we are in monthly options expiration week, some of that bleeds into Monday's price action. But also don't forget, this was kind of the expectation, right? This chart from Larry Williams that we had discussed in the past about where the Dow, where the S&P 500 and NASDAQ could possibly be going. Another dip here in September, possibly leading to an end-of-year rally or fourth quarter through the end-of-year rally. The seasonals are playing out pretty darn well. This is us coming into September. We might go out with a bang. Remains to be seen. This is the Larry Williams 4-year cycle outlook. The good news at this point, right, because technical patterns are all about what has happened and what is developing. So far, even with this week's decline, we're still making higher lows than back in June, back in May, back in March, where we were just making a series of lower lows. So, if the glass is going to be half full, this is one way of looking at the glass being half full. We want to hold on to that 3,900 level, no doubt. We'll see if we can. Things could get a little bit more dicey if we do. Here's a look at the S&P 500, what I don't like. What I don't like is that we do keep brushing up against that 3,900 level. This week so far, we've been able to achieve support at the 618 Fibonacci level for both the S&P and the NASDAQ. We may not be able to hold on to that today. We're just below it here today. I'm sorry, just above it right now. It comes in at 3,909 on the NASDAQ, on the S&P 500. But 3,900 also, we've tapped on it once here for support. Things did break down, obviously. We tapped on it again for support, again for support. We may tap on it again here this week. You know what they say, tap on that support too many times. It's the same as if you brush up against resistance levels, eventually you break through. So we're looking for this 3,900 level to hold. If it doesn't, it opens the door for more downside, and we just have to be able to anticipate additional downside. How do you do that? Look at your cash balance in your account, folks. Make sure that you have a healthy amount of cash to take advantage of that potential cascading if we do break through 3,900. Chart right. And the funny thing, we had 4 really nice up days in a row until Tuesday's CPI reading. Really nice gains. S&P 500 performance, we had greater than 5% gain in just 4 trading days. And when that happens, historically, returns are fairly positive here. Going out 1 month, 69% of the time, market's positive. This data goes all the way back to 1950. A lot of examples, obviously. 3-month return, 65% positivity rate. 6-month return gets much better, nearly 80%. 12-month return, 86%. Could this time be different? It could. A lot of these types of 4-day gains happened ahead of the dot-com bubble. They happened ahead of 2008 financial crisis, towards the bottom of the financial crisis. So they can happen really randomly during uptrends and on the precipice of a really big, steep decline. So do be aware. This is, again, just revisiting when you have 90% of stocks trading above their 50-day moving average. Historically, good things are happening. So we're checking in. Why? Because we just passed the 1-month mile marker, 1 month or 21 days from when this breath thrust basically fired, which was on August 12th. August 12th. So 1 month later, September 12th, we're supposed to have an 88% positivity rate. Unfortunately, it didn't come to pass. We satisfied 12% negativity rate because since August 12th, the S&P 500 has lost a little more than 4%. It just hasn't lived up to the hype. We want to keep this in play because 42 days or 2 months later, the percent positivity rate is even stronger. And then we got 100 percentiles going out further in time. But for now, we fell into the 12% negativity rate. Probability. So the S&P 500, man, Tuesday was bad. Not just for the S&P 500, but think about the NASDAQ, which was down more than 5%. This table here is from the Almanac Trader, and it goes all the way back to 1950. And it tracks when the S&P 500 has had a daily loss of 4% or greater, like it did on Tuesday when the CPI, Consumer Price Index data, came out. 1 month later, after that kind of one-day decline, 61% of the time the market is positive. The average return, 1.7%. Going further out in time, let's go out 3 months, percent positivity rate climbs going out 6 months, it climbs going out 12 months. And as you can see, the gains are larger each time. Here's the other thing to consider, folks. The last time this happened, I believe, was June of 2020. June of 2020, we had a one-day drop of 4% or greater. The S&P 500 is up 30% since June 2020. There you go. Not all data is going to work out, folks. Okay, the percent positivity, when you have 90% of stocks trade above their 50-day moving, it just didn't work this time. There was a 12% probability that it wouldn't. It is the lower probability, but sometimes that's just the way the data works out. I prefer breadth data as opposed to sentiment data. And the sentiment data that you're looking at right here, this is the AAII sentiment data. It's just your average investors. It comes out every Thursday. This is from the Sentiment Trader, but of course. And we got to a level where you're below 20. The percent of bullishness is below 20% in the survey. Usually good things are going to happen in the market going out into the future. This one we took in April. This is from April, this particular data series. But unfortunately, just like our 90% of stocks trading above their 50-day moving average, this didn't work out either at the three-month mile marker. Supposed to have an average return of 5.5%. We're lower than we were in April. The S&P 500 is lower than where it was in April. The sentiment data, as I always say, don't use in isolation. The same way I say don't use seasonal. It's not optimal to use sentiment data or seasonal data in isolation. You want something that is more centered and focused on the market internals themselves. But this failed. At the three-month mile marker, this particular 94% positivity rate. And we fell into the 6%. Right? And this is where you start to say to yourself, something's different this time, right? Something's different. What is that difference? Maybe it's the Fed, right? The Fed is tightening. We have a war in Ukraine. We have inflation levels at 40-year highs, right? This data only goes back to 1990. That's not 40 years ago. So we're figuring out what's different. Now, this is similar. This is from the Conference Board. It's another gauge of consumer expectations of stock performance going forward. This is a survey from the Conference Board asking investors what they think the stock market performance is going forward. Recently, it went from a move below -10 back up above that level. And as we can see in the past, when it gets below -10, usually there's troughing going on and the market trends higher. Here, below -10, then crosses back above, market went higher, go all the way back in time. This drop below, gets back above, goes higher. And that's what happened just now. And this is never, it doesn't matter where you are so far as duration. 1 month later, 3 months later, 6 months, they're all 100 percentile. The signals just don't get any better than this, folks. But that's sentiment data. So you should be pairing it with some kind of market internal data. Said how bad it was for, mentioned how bad it was for the S&P 500 on Tuesday, down more than 4%. We were down more than 5% on the NASDAQ composite, I should say. This is the number of times already this year that the NASDAQ composite has been down 4% or greater, 7 times. Now in 2020, with the pandemic, it was down that much or greater 10 times. But between 2012 and 2018, it had only done it 3 times previously. 2012 to 2000, only 3 occurrences where the NASDAQ composite was down 4% or greater in a day. Yeah, there's a lot of volatility here this year, folks. It's not showing up in the VIX, but it's showing up in realized price action or realized volatility. I mentioned that we got the FOMC meeting on deck next week. So we know we're going to get a 75 basis point rate hike. That was at least my last purview at the Fed Fund futures. Let's just take a gander real quickly here, see if that's the case at the moment. I know there's been a lot of consternation about the possibility of a 100 basis point rate hike, and that's not going to happen. Unless the 100 basis point probability gets above 60%, and this one fades at least down to 40%, we're getting a 75 basis point hike. Whichever one of these is above 60% probability is the one we're getting. So keep an eye on that leading up to Wednesday's FOMC meeting. Now, how has the market performed on FOMC rate hike day this year? Here we are. In March, we raised by 25 basis points. The market was up 2.24% that day. 50 basis points in May, almost 3% return that day. 75 basis points, 75 basis points, two other meetings, up 1.5%, up 2.6%. I guess folks like rate hike day, or they like that the Fed is doing their job at fighting inflation, right? They want to feel, investors want to feel and believe that the Fed is going to get this under control. Nonetheless, the next day's performance carried more gains, but man alive, gained 3% on Fed rate hike day in May. The next day took it all back and then some. Gained 1.5% in June, took it all back times 2. And then, of course, in July, it had more follow through. So 9/21, next Wednesday, we'll see how the market performs. Okay. Whenever we hit, this is the New York Fed recession probability tracker, this chart right here. Possibility or probability of a US recession 12 months ahead has jumped to 25% probability. That sounds low, but here's the thing. Every time it's gotten to 25%, recession, recession, recession followed within 12 months at least. So everybody's got recession on the brain, even though through the month of July, the big four indicators accelerated 16.47 to 16.87. You can look at all big four indicators: employment, industrial production, real sales, real income. We'll talk about real sales because that's retail sales in just a minute, because the data was released today. We got August retail sales. So we'll talk about that in just a moment. But we actually accelerated across all big four indicators from June to July. And it seems like we're doing that same thing here going into August, regardless of what the GDP tracking suggests. A lot of people, they'll look at these indicators and say, yeah, but those are lagging. It's lagging data. The reality is you can turn any data of consequence, any key economic data, you can turn it from a lagging indicator into a leading indicator. If we go back in history and we take the big four indicators, so we're looking at the big four indicators, and we look at when they were in, at all-time highs versus the distance that they fell to when a recession began, we can see, we can view them as a leading indicator. So if right now we're at this level and the average recession starts when the big four are at this level, we're not there. We got to go down. And that's how you turn it into a leading indicator. Keep an eye on this particular chart. I'll update it in the weekend research report at phenomgroup.com. All right, so we got the August consumer price index. Seth, you told us that inflation was dropping. It is falling. Not every single component of the consumer price index is falling, but overall, the CPI is now down 2 months in a row. So it is falling, but there are components within the CPI that are not yet falling. And we have to be conscious of the fact that the main component, the most heavily weighted component of the CPI, is rent. And we've talked about rent still growing on a month over month and year over year basis. We think it's rolled over now on a month over month basis. Have a nice chart to show you in that respect. Before doing so, meet Chris Salviati. He is the owner operator of apartmentlist.com. And as you can see, based on their listings, which are national, indeed, we have seen the month over month fall over. But as we also know, there are problems with the questionnaire offered to renters, I should say leasers of their property. Essentially, the OER, the owner's equivalent rent, is just a question. How much do you think you could get for your property if you were to rent it? Not only that, it's about the data gathering. It works with a big lag. It works with a very big lag. We've talked about that before. So much so that we don't think this rolling over of rental prices will show up until maybe November, December, even January of the new year. We want the Fed to be aware of that. We hope the Fed is aware of it, but we can't count on it, which lends itself to the possibility the Fed may over tighten. What do you think the market has been pricing in, though? The market isn't down just because. The market is pricing in all of this tightening, and which may lead to lower earnings potential. Nonetheless, what we do see is the BLS, right? The Bureau of Labor and Statistics, who is in charge of all the data gathering and dissemination for the CPI. They know there's a problem. They know that the way they go about aggregating and collecting the owner's equivalent rent is a problem. So they did a study, basically changing the structure of the owner's equivalent rent data. They went back from a period of 2013 to 2016 because that was kind of a stable period with the PCE as well as the CPI. And what they found is with this new structure, it more accurately calculates the owner's equivalent rent. And it would have shaved, I think it's something like, 0.34% off of annual CPI by using this methodology. So they are going to make a weighting adjustment and a structural adjustment to the owner's equivalent rent within the CPI as of January 2023. I wasn't just, trying to assuage concerns about OER. It's been a problem, and they're going to do something about it. All right, what do we got here? This chart. Why did the market have such a severe reaction to the Consumer Price Index report cooling less than anticipated? Right? Everybody thought it was going to be a decline on a month-over-month basis of 0.1%. Instead, it was a upswing of 0.1 on a month-over-month basis. It's all about expectations. It's all about expectations as well as the ramifications. The ramifications are the Fed will keep tightening if they don't believe that CPI, inflation, is abating. And so that's why the market had a bigger reaction than most people probably assume. The market continues to see the Fed rate hike peaking in March 2023 now, right? Because the Fed fund target rate was prior to the CPI at 4%. Now it's at almost 4.5%. Pushed out to March 2023, possibly being the peak. And so that's why you had the market basically pricing in a higher Fed fund target rate. Like when you actually sit back and realize why we're down 4%, it's the markets are always discounting something. Usually it's earnings, and usually that's tied to, well, are we tightening fiscal policy that might put a crimp on the economy, and that crimp on the economy will possibly be negative for earnings. So the market had what I refer to as a VAR shock, a volatility adjusted risk shock. Now, again, I said the CPI went down on a It did. The year over year is down 2 consecutive months. The core rate is down now 5. We've seen peak inflation. The concern is because it's not rolling over hard enough, steeply enough, we might get another hiccup. But that's not usually the case. It's just not usually the case. And these notes from Jim Paulson of the Lighthole Group, he believes that the peak was in June. Peak was in June, and usually, based on the last, I think he said 7 inflation peaks, the market has bottomed. And he had 3 different charts. I just picked one of them, and it shows you inflation peak, market bottom. Inflation peak, market bottom. Inflation peak here, and the market bottomed here. 1951. All right. Talked about recession. Talk a little bit more about it. I do want to get to those retail sales because kind of leads to this whole recession probability risk, if you will. Bank of America, right? They thought we'd be in a recession by Q4. These notes right here outline, they're pushing that recession out to Q1 of 2023. So even Bank of America is surprised by maybe that acceleration from June to July lasts through August and through or into September. So they pushed out their recession probability model and actual occurrence to Q1 of 2023. Bank of America also does their fund manager survey every month. This particular one is about profit expectations, right? Net percent of fund manager investors saying global profits will improve is basically at an all-time low level. They don't believe that the earnings are going to be there in 2023. Do we need the earnings to be there in 2023? We'd like for them to be there in 2023, but that's not always the case. Does that mean the market will be down? Not always. In fact, here, remember, a lot of times we'll get multiple contraction during recessions. This data right here is PE multiple during recession when the PE multiple troughs since 1970. We've looked at a chart of that before, you might recall, but the reason I took away the chart this time is because this is more impactful, I believe. Charts can sometimes disguise or mask what's really important when we're talking about multiples. 1970, recession, multiple troughed at 13.5. 1974, 8. 1982, 8. 1986, 15 plus. 1990, 15 plus. 2001, 20 times. 2008, 16 plus. It's so random, which is why most people use the average. But that's kind of why I took the chart away. It could be any of this or none of these. What about 14? What about 17? What about 12? It could be any number. It's so random. We've never had the same PE multiple trough. This is another one from the fund manager survey, Bank of America. Investor risk appetite, just like the belief that profits will be there next year. Look at investor risk appetite. It's lower than even 2008. This is essentially saying investors aren't willing to take risk. But what I would also hope that you see in here, when they weren't able to take risk or willing to take risk, what did the market do after it finally did bottom in early 2009? Up and away. What about 2012, right? 2012 to 2014, back to back double-digit return years for the S&P 500. What about 2020 and the pandemic? Well, we know we gained into the end of the year there. I think we were up 17, 18% in 2020. So don't focus on how negative this looks and the lack of risk appetite. Recall your history. This was you're getting value. Where others don't see the value opportunity, I believe you should. Peak to trough declines around recessions. Sometimes you get recency bias. So for that, I did include this chart right here from Gina Adams of Bloomberg, I think her name is. Recency bias could be affecting market psychology on what to expect from EPS. Should we enter a recession? right? Recession in 2008, 2009. Wow, right? I mean, earnings declined precipitously. 2001, earnings declined precipitously. But before that, not so much. So the average EPS decrease affiliated with recessions going back to 1960 is 31% because we're including 2009 and 2001. But when you exclude 2008 or 9 and 2001, the average EPS decline is just 17%. So got to keep that in mind, folks. I didn't put, she didn't put 2020 in there. While 2020 isn't counted in the above chart, the EPS decline for 2020 was 14%. So it was less than even when you exclude the 2001 and 2008. It could be any EPS decline. We don't know the magnitude. We can't predict the magnitude of a potential recession that isn't here. This is from Goldman Sachs, the median EPS decline of 13% during prior recessions. Right around 13%. Again, if you do include 2020, but we're also going further back in time to 1949 as opposed to 1960. Again, some of this data, it depends on your start and your finish dates. It's just not worth your consideration in my opinion. They're all over the place. You never know. Here's one thing to consider from JP Morgan, though. Fun fact, and this is from Michael Sembalist of JP Morgan. If earnings do decline in 2023, will markets make lower lows? Okay, what if we don't have a recession? In post-World War II era, a decline in EPS of 7% or less, so not 14%, not 17%, not 31%, but 7% or less, you probably don't have a recession or you have an extremely mild recession. The market has never produced a negative return. So can earnings decline next year, but the S&P 500 be up? Yes. As long as, well, according to history, if those earnings are not greater than 7%. So I went back and I looked at all the years where we had negative EPS, earnings were down, from 1960 to 2020, the S&P 500, when it was up 1, 2, 3, 4, 5, 6, 7, 8, 9 times, out of these 14 years, only down 1, 2, 3, 4, 5 times. Indeed, in fact, the market is usually up more so than it's down, more times than it's down. And this goes back to what I think is a better way to consider what the PE ratio might be based on where we started, because the last 10 bear markets have an average PE derating of 7 multiple points, right? I mean, because we're always starting at a different place if we enter a recession or we have a bear market. The PE is never the same starting point. So it's almost a better idea to use how many multiple points on average have past bear markets expressed. And by the way, this one from the peak at 22 to the trough in June was a 7 multiple point derating, 22 to 15. That's what I like to see. Now, I had mentioned retail sales, so I don't want to miss that. Folks, how are we in a recession and yet retail sales are growing at 9%? On a month-over-month basis, they're growing 0.3%. Real retail sales, which account for inflation, are still, when you do a mean regression trend line, substantially above the pre-COVID levels in 2019. Last check, where the markets are as we close out here, no real change. So our state of the market didn't do any damage here to the market during our recording. With that being said, we're looking forward to quad witching monthly options expiration on Friday. Next week, we've got the FOMC meeting and press conference with Jerome Powell. For now, I'm Seth Golden, and we are Finom Group. See you next week, folks.